Hello, this is Emily Cressy, and I'm here to talk to you today a little bit about market cycles. Now, market cycles are a natural part of real estate, and it's funny because over the last couple of years we've seen a big boom in real estate prices. Things have been going up, up, up. Banks have been very free with money, which has pushed prices up higher, and we thought that it would never end. Now that the market is going down or correcting strongly in some areas, it feels like the sky is falling. What I'd like to do is discuss some of those ins and outs in a general way and talk about what you can do to be a smart user of those market cycles rather than an unseeing victim of them. Now, on this board behind me, you'll see that I've drawn several lines. This blue line is sort of a sine wave here. It represents the ups and downs of real estate cycles. And generally, they're fairly slow cycles. It might be 5 or 10 years from one top to the next top of the cycle. It takes a while. So we were having an up period for several years, maybe 5 years here, and now things are starting to go down. They'll go down, down, down until such a point as things are cheap, and then they'll start going up again. Up and down, up and down, up and down. Now, over time, if you looked at, rather than year to year, if you looked at a 20-year or 30-year period and took the national average, we'd see an upward trend here. So we'd see approximately a 6% annual average price increase in housing over that long-term cycle. However, if you look at a shorter term, the picture might be very different. In some areas like Florida, California, Las Vegas, some parts of the East Coast, you see a lot of volatility in the prices. When things were good, they were very, very good, and we saw double-digit appreciation rates, 10 and 20% annual price appreciation. That's a huge amount compared to the historic 6% national average. On the other hand, when things correct, we see big price declines too. So they go up a lot and then they go down a lot. Now hopefully they don't go down all the way, they maintain some of that value, and then when they go up again they push that top a little bit higher. So over time you're still going to see a positive growth of housing prices, but over the short term, if we looked at prices now as compared to a year ago, we might actually find that they're lower. So if you're in one of those volatile markets, you might be hurting right now, but it's also a good buying opportunity if you've got the cash available. Now, on the other hand, let's talk about some different markets. I got started investing in Winston-Salem, North Carolina. I felt like such a stooge when I was investing there. I'd buy a home, and it was worth the same amount the year I bought it as the next year and the next year. And I saw my friends buying in California and Arizona and all these hot, flashy cities that were going up hugely. But now I'm glad that I'm not experiencing any loss. North Carolina is a market that has a very slow and steady appreciation rate of about 2 to 3% a year. So it just chugs. It's not going up, it's not going down, it's just chugging along. So that's sort of what this green line represents. It's a slow but steady growth curve over time. Now, if you were buying property in one of these markets and you weren't planning to sell for 20 years, I would probably take the house in the market that was going up 6% or more on average, because if you're not selling here and you're not selling here, you don't care that the value of the home has declined or gone up. All you care about is what the price was when you bought it and what the price is going to be when you sell it. So if you buy low and you have 6% appreciation for the 20 years, you're going to sell it at a higher price than if you buy low and you have 3% appreciation over the time period. But what if you could do this? What if, instead of buying and holding for 20 years through all these ups and downs, what if you could buy when it was low and sell a few years later when it was high? Then you might make some real money. And that's something that is hard to do, but I have found out about a program that tries to do exactly this. They're using a lot of historical data and tracking market cycles to see what the average length is of the cycles, and how far up and down they tend to go, and it's trying to help investors with this type of information. So it might be something that you'd like to check out if you beat a couple of criteria. Number one, these markets that tend to be volatile and have higher growth are tending to be the more expensive markets. The Californias, the Washington DCs, the Floridas. So you have to be able to buy in those areas even if you don't live there, and potentially in some of those higher price markets it can be harder to cash flow homes unless you come in with a big down payment, or you're able to find motivated sellers and get some owner financing or some kind of special arrangement, buying at a discount, that type of thing. So don't look into this service if you're not able to buy in the areas that it recommends. You can, however, look at the performance of your own area. If you live in North Carolina, or a very flat market, some of the Midwest states, they're not going to show you much. You're going to say, yep, you know, we're going up 4% this year, we're going down 1% this year. Without those big volatile changes, you're not going to capture a lot of benefit from turning over the properties. In order to take the most advantage of this information, you're going to have a property that goes up over maybe a 5-year period of time. You sell it, you pay those transaction costs of working with a real estate agent, having generally some holding costs while it's vacant, maybe fix up to repair it after the tenant left. So this is a somewhat more costly way to conduct your real estate, and in order to make it profitable, you need to be in a market that has those high ups and high downs. So I hope that's helpful. If this is something you're interested in learning more about, I encourage you to research the market timing program mentioned in the link below. Thanks so much and have a great day.